This is our Forex blog for April 4th, 2013, and one of the things that I think is the easiest way of trading is to just use our currency indexes. This is a tool that I created that isn't available on any other platform, and it basically shows each individual currency, the dollar, the yen, as a standalone chart with a bunch of information on there that clearly lets you see the trend, not just the direction, but is it above or below that index's hourly or 15-minute moving average in green, hourly's in gray. Is it above or below the average price of all the dollar pairs? And you can see the yellow line right here. You can also see that the point of control the previous day, the yellow line yesterday, fell 25 pips. And a lot of times if it finds resistance right there, knowing that yesterday was a down day, it's more likely to go down. Once it breaks above the point of control, obviously it's a very strong trend. The orange, which sometimes shows up, sometimes doesn't, because it could be off above or below the current price. It shows the average price of the dollar during the previous week. So when a currency is above its hourly moving average, and especially the previous day's point of control, that's a trend that's very likely to go up. You can see that one went up, this one went up. Notice how it acted as support in the euro. Notice how the weekly acted as support in the Swiss. The Australian, previous week's point of control could not get above that level. These are major levels. Notice the New Zealand. Yesterday the point of control went up 57 pips, but it was a major resistance area, and it had a false breakout above and then came back down and popped above it again later, but it was major resistance for hours. So basically, how do you trade with this? Well, you just simply want to buy the strong ones versus the weak, sell the weak ones versus the strong. And now, because in the past we would use a currency meter that would show statistically how strong the dollar is or how weak today the yen is, and you would basically use the currency meter in the past. Now you have a chart and you can clearly see if it goes, for instance, above yesterday's high. Is the Swiss stronger today, right now, than it was all day yesterday? That's pretty significant information that the old currency meter unfortunately couldn't give you. You can also draw trend lines on it. You can see double tops, double bottoms, wedge patterns, flag patterns, continuation patterns, reversal patterns. We have the containment bands on here, and typically once it's above the 2.0 band, it's going to run out of steam. You might take one more buy in it, but that's pretty much it. And you can see it went sideways for many hours and then fell the rest of the day. That's the power of it. The upper containment band the white one tends to contain price. Look at the CAD, barely got above it. The pound got up to that level, and basically the white level 90% of the time, 80-90% of the days is going to be the end of the move very quickly. The yen's an exception today due to the news. Huge move down. So anyway, we want to buy the dollar yen, we want to buy the euro yen, the Swiss is above all these levels. You want to buy that. You want to buy the CAD yen, New Zealand yen after 1, and then also the Australian. Now, not only does this tool help you find which currencies to trade, when to trade them, it also lets you know which currencies not to trade. For instance, the Australian. This one's stuck between the point of control and the hourly moving average, two major support and resistance areas. And you can see it was very choppy. That tends to happen over and over again. If, on the other hand, you see the pound above the hourly, above its point of control, the next resistance where it's going to stall out is right here, and it's a considerable distance away, which gives you good potential for making profitable trades. So let's look at the CAD yen and dollar yen, and also the euro yen. These are some of the ones that you'd be trading today based on this. And you can use 5-minute charts, 2-minute charts, 3-minute charts, range charts. But we're going to just use a 5-minute chart to keep it simple here. Let's start with the dollar yen. It was strong above its hourly, above the point of control. Here's some of the entries that you would have had when it went from below to above the hourly right here. This little pullback trade right here, this little pullback trade right here. And basically there's two entries that we use for these. Once you identify a currency, there's there's more than two, but there's two main patterns. One is a little pullback. You visualize a trend line over the bar's highs when it's trending up, and when it breaks that trend line and you get in with your stop underneath the low. You can see that entry right here. The second entry would be a 30 minutes to 2-hour rectangle pattern. You know, for instance, maybe something like this. Obviously, this was in a downtrend later today. When it broke out of that 2-hour rectangle pattern, you go short right here. And depending on how far away the high is, you might put your stop right here. Or what I oftentimes do is just, you know, I don't mind getting in and out, sometimes 3 times. I'd much rather lose 4 pips than 10 or 12. You know, so if I'm wrong with 4 pips, sometimes I'll do 1.5 times my initial position on the second trade, which usually works. If not, I might double up on the next trade. So even if I only make 10 pips, because I have a bigger lot size and I know the accuracy of my own trading, I can, you know, take calculated risk at appropriate times. But actually, you know what? I put the dollar Swiss on here. Sorry, I meant to put the dollar yen. Here we go. That's, I wonder why it didn't go up that much. Here, this one went above the hourly right here, and really that's your only entry. When it's this far above the upper 2.0 band, it's a relatively risky trade. This thing on the perfect oscillator is off the charts, and so you just basically ride that up, and you know, the first sign of it kind of stalling, you're out of your trade somewhere right here. And the only other option to get back in, because it worked its way, the band's kind of caught up to it. You have a multi-hour rectangle / wedge pattern right here. This breakout right here is pretty high probability as well. And this is a good example of why you would want to use a tick chart or a range chart to take a trade like this. Let me bring this same chart up on a, we'll start with a 50 ticks per bar. Every time there's 50 price changes, there's a new bar. And so this time here around 9 on a tick chart probably gives you some really good entries. You can see it went sideways for many hours, and it broke out of that trend line right there. Also, right before the trend line breakout, you have a very tight, low volatility pattern. One thing that's even more predictable than price is volatility. Volatility goes from high to low to high to low. And so when you see volatility, obviously in the direction of the trend, getting smaller and smaller, you can see it's getting narrower and narrower, the lines are converging, boom, big move. So later in the day I would have taken this one, probably because it was already up too much, kind of drew my trend line on there and would have probably got out of this trade somewhere at 67, in this at 45. And you know, I might have taken a stab at this first pullback and it would have been a loss, and then the second pullback was not a loss. And again, you don't know where it's going to stop, so you just kind of want to, you know, draw your trend line on the way up here. Any time it kind of goes sideways, I don't like to get out of a trend trade based on sideways move. A trend line can get broken by just the price going sideways. So when I see a trend line like this, I'm kind of eyeballing it with my stop right here. If it's kind of going sideways a little bit more, I might move my stop up underneath that swing low, but I'm not going to let a sideways move breaking the trend line get me out. It's got to actually come down. So that's the 50 tick per bar chart. You can also see a 5 pips per bar range chart as well. And these are basically, each bar is 5 pips. And so it's a beautiful way to keep your losses small. You buy that breakout right here, and you can just kind of put your stop underneath each bar's low by a pip or two. And you know, it does a really good job as well, even better than the tick chart, of letting you kind of get out of that trade right up here. So we all know that the CAD also exploded up, so we'll take a look at that one. CAD yen, you're going to see look very similar. Just exploded, and the same kind of pattern happens right here. Now, what do you do if you start trading in the markets up here, significant amount above the band? Well, really the only thing to do is use a really tight or fast chart, like maybe a 1-minute chart, 2-minute chart, 30 or 40 tick chart, or even as low as a 3 pips per bar range chart. So let's take a look at that. 2 o'clock. This is how you catch certain trades with the most tiny amount of risk. You know, what do you do when you want to take a trade? You know it's going to go up, but you don't want to get burned. Yeah, you know, so risk smaller number of pips. And once this comes in, I'm going to change it maybe to 4 pips per bar chart. We'll look at the chart of around 130 or so. So here we go. You can see very, very small bars. Each one's 4 pips. You buy that breakout right here, you can kind of watch it like a hawk. You might get out of that trade there with only, actually that's probably a 15 pip move. And because it's up too much, you don't know what's going to do. You can also put a chandelier trailing stop on there. And because it's up too much, normally, or a lot of times I use a 3 times stop. You might use a 1.5 or 2 times stop. But you can see this trend was so strong that you're in here, out. You might have bought that again here at 93.25, went up another 75 pips. And again, you can always use fib targets too. Just move from here to here. I probably would have been out somewhere around the 1.382 fib target. Obviously, everyone who traded against the yen today made money. So let's look at some other examples on how to use this. Forget the yen. This one could not get above the point of control all day. It's also in a very, very tight range rectangle all day. So when it finally broke down here after or right before 10 o'clock, that's an excellent one to be selling. So we're going to scroll these charts back and look at and find which ones are strong as this thing's kind of, you're watching it right now as the potential to fall. You're just waiting for that low to get broken. And so which currency is strong? Well, the euro's going up right now, and it was strong earlier. The dollar trended up strong earlier. It found support to hourly. It's right there. The yen's weak. You're not going to do that. I like the pound, but it's already up near a resistance area. I prefer currencies that maybe have pulled back a little bit, that if they start to go up, they have a good room to run. You want to risk a small amount, and you want to have a win that's a considerable bigger amount than what your risk is. So for that reason, I like the CAD. I like the New Zealand. It just broke through a major resistance. So at coming up to 10, I'm looking at maybe selling the Australian New Zealand. I'm looking at selling the Australian CAD. All right, let's take a look at those. Remember, coming up to 10, you had quite a bit of time to prepare for that. So here we have a breakdown right here, and our stops right above the high here. Usually currencies that are going my way are going to continue, so I probably, in all honesty, would have got out of this with a very, very small profit, or maybe even a 1 or 2 pip loss with a spread. This is a perfect reason why you can use 5-minute charts, but range charts and tick charts are going to be better, because you're going to see this pullback right here and get short again. See this pullback here. And typically when they're kind of going sideways, I'm going to let them run. And you always want to draw your fibs on this. This is your fib target down here. Let's take a look at the Australian CAD. This is another one that you want to be selling. Coming up to 10. Alright, so coming up to 10, this is near its lows. Oops, I didn't mean to put that tool on there. I want to align. There we go. And you can see in this case, you maybe made 15 pips on the first one and 20 pips on the second one. Very high probability. Also, one of the highest probability trades. I love this trade. I would say it's the #1 highest probability trade. When you have a strong trend down and the market goes above the 80 level, you're just kind of looking for sells. Now this one you would have lost. But this is what typically happens. When you get a pullback up, the 80 level gets hit, great trade. And so if you're watching a currency because of the currency index and you see this on the actual chart, it's phenomenal. And you can also kind of just wait for the lows to get broken. And by doing that, when you see this earlier, just kind of drawing your trend line up here. And remember, you don't want to let a sideways move get you into a trade. You want to wait for the lows to get broken right here. So you'd be short there at 105.80. And instead of having a loss and having to get back in, by waiting for price to confirm it, you have a nice win there. Let's go back And by the way, you can see a little bit better and more clearly on how you can use it so many different ways. For instance, explosive move up, came down, found support here at the point of control. You might say, well, when this thing breaks out again, I want to get in. And you would have been long the euro at 5 o'clock, 5 something. Another trade is, this thing had every opportunity to continue its trend up, and it failed. It wasn't able to even go back up to the highs, and so when it broke down here at 8:30, that was a great short. I'd be a little hesitant to buy here, but you can see it was so strong earlier, and it broke through the previous day's high that because it found support right here, you can give this a shot, or when it breaks back above here, and it's likely to come up to this range here. You don't know it's going to explode up. You also have nice, beautiful little wedge pattern right here. These are some of the entries that I think are very, very high probability. Right here. Now, obviously, not all of them are super good. You also have another trend line off the lows here. You can see it went up, pulled back, went up again. The statistical momentum fell. See that? And it fell even more. So the momentum is running out. It's at the first band. Pretty high probability counter trend short right here. And you can see for about an hour it fell. So you have so many ways of using these indexes. And all you got to do is find one currency that's very likely, like right here, 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 and here, to be going in one direction. And hopefully you find another currency that's likely to go the other direction, or is going in another direction, or it can also even be going sideways. If you're right about one currency and the other currency just goes sideways on the chart, like this, you will make 5 to 20 pips. If one currency is moving up and the other currency is going sideways, you'll make 5 to 20 pips. That's my personal experience with this. If one currency is going up and another currency is going down, and you're in the right side of that, in other words, you didn't pick the opposite, for whatever reason you were wrong, you picked the wrong one, you bet the one that was going up and it goes down, and vice versa. If you bet the one that goes up against one that goes down, you'll tend to make 20 to 50 pips. And today, with most of the yen pairs, over 100 pips. So 100 pips is definitely happens maybe 1 out of 8 or 1 out of 10 days. But most days, if you pick one that's and you're right and it goes up, and the other one goes down, you're going to make 20 to 50 pips. But you only have to pick one, really. If you pick one that's kind of going down and the other one just goes sideways, again, you're going to make 5 to 15 pips. So let's take a look at that counter trend trade right here at 4 o'clock. Which currency at 4 o'clock is likely to go up? So let's scroll this back and look. If the New Zealand busted through this high here, I'd be all over the New Zealand. I like the CAD, but it's already up statistically too much. You don't want to buy a currency that's up too much. This one, the pound, has been trending up all day, and it's right at support. It already broke through the previous day's high of the pound index, so I really like the pound. And normally, I would consider buying a counter trend trade like the yen that's down too much. But anytime it falls this far past the bands, there's something major going on. You don't want to mess with a currency like that, so I wouldn't do any counter trend trade here. Also, keep in mind here that this one broke down a little bit before 4, so we should kind of scroll back a little bit more here before it broke down. All right. Okay, you can see the dollar, it's up too much. It's above its upper band. It's likely to pull back. And actually, no, we're looking for one that's going to be going up here. The Swiss, because it's already pulled back a little bit, you could consider that. The New Zealand, if it does break out, you want to be buying that. These are the charts you're going to be actually looking at for trading. And I still like the pound too. So we'll take a look coming up to 4 on selling the euro pound. So here is coming up before 4 o'clock, right? This is when we're kind of watching the chart. This particular chart's above the 1.5 containment band. Price on many instances went above our perfect oscillator's extreme level. And so when it breaks this level right here, you're short with your stop right here. And you could say the hourly moving average is your profit target. And this thing pulled back 20 pips while risking 10 pips. So that was a trade that gave you 2 times bigger profit than what your risk is. And that's really the only key to trading here. And also notice on this pullback right here, perfect oscillator hit the -80. Usually these -80 levels, with a few exceptions, this one here was wrong, this one was right. You know, this one pretty much preceded this big counter trend move up. This one was wrong. This one nailed the high. Today had above average volatility, but this is based on the 20-day extreme volatility. If today's volatility is more than the last 20 days, then you know price can explode through these, but most of the time it doesn't. 9 out of 10 or 10 out of 12 days, these bands, the 80 levels, pretty much within 2 or 3 pips are the high and low of the move. So that's how you use these tools. Hopefully this makes sense, but I'm going to keep going over anticipatory ways. You know, for instance, the CAD. It's up a lot. If it breaks this trend line, you want to sell it because it's gone up statistically too far. So let's draw a regular trend line on there. We can see going forward what happens. Continues. Again, I don't want a trend line to get broken with a sideways move. I want to wait for it to break that low. Okay, so you're looking at 5 o'clock and selling this CAD. Looks like the Euro's found support and it's going to go back up. 5 o'clock, the Euro CAD could be a very high probability trade. And if it isn't, you're going to lose 5 to 10 pips. Remember, the Euro is likely to go up. The CAD is likely to go down. 5 o'clock, we're looking for a buy right here. So this is kind of what happened. It kind of went up a little bit, came back down, didn't hit your stop, kind of went up a little bit. I would have probably got out of my trade here, re-entered here, made a little bit, got out of it at the hourly here. But you can see the Euro did kind of inch its way up, whereas on the index chart, the CAD was finally starting to pull back a little bit, and you made money on that trade. This is, you know, a 50 pip distance here. So even if you were using a range chart, you might have lost on the first trade, got in again here, made 10 or 15 pips, got in again here, made 10, 15 pips. But regardless, you would have made money on whether you got in and held or you got in, out, in, out, in, out. You would have made money net. So that's all that matters. You know, not every trade using this method is going to work, and it doesn't work. You know, there's no tool or system in existence that doesn't have losing trades occasionally.